The dollar is losing altitude, and the metals market is already pricing the part most people are still arguing about. Not fear, not meme momentum, not some random headline. This is a funding signal first, and if you understand the one FX tell metals traders watch before they even glance at gold, you'll know what matters next week, what level flips the setup, and what breaks if the dollar tries to snap back. Because right now, the conflict isn't bulls versus bears, it's price discovery versus narrative control. You're going to hear a lot of clean, comforting explanations. Gold is up because geopolitics. Silver is up because industrial demand. The dollar is down because risk off. Cute stories, but the tape is colder than that. And when the tape gets cold, it gets honest. The dollar doesn't move like a stock. The dollar moves like plumbing. Pressure builds, valves tighten. Someone starts paying up for immediacy. And then suddenly the whole system reprices in a weekend. Here's the blunt context because you need anchors. As of the Friday close, DXY is sitting around the high 97s, roughly 97.5. That's not a crash. That's a sag, a slow leak. The kind that looks normal until you realize it, S happening. While metals are printing numbers that force everyone to update their mental models, gold has been flirting with the $5,000 handle, and silver just punched through $100 and didn't tease, politely back off. It closed around 103. That it's not a casual move. That's not a nice trend. That's a regime shift trying to announce itself and being dismissed as a headline trade, but that's not the part that matters. The part that matters is that metals traders who actually live in this market don't start with gold. They start with the dollar, because the dollar decides who gets forced to buy. It decides whose hedge explodes. It decides whether the next rally is organic demand or reflexive, mechanical, and violent. And here's the first thing to understand. DXY is not the dollar in the abstract. It's a basket. Heavy euro, heavy yen, some pound, some Canada, some Sweden, some Switzerland. So when DXY is under pressure, it usually means some combination of Europe isn't as weak as people assumed, Japan isn't as powerless as people assumed, and global capital is demanding a higher risk premium to sit inside US assets without protection. That last part is the quiet one. That's the one that doesn't fit neatly into a headline. And that's where the real pressure starts. Now tie it directly to metals. Gold is priced globally, but it's quoted in dollars. That means a weaker dollar mechanically lowers the price for non-U. S buyers in their own currency. Unless gold is rising so fast, it outruns the FX benefit. And when gold rises, even as their currency strengthens, that's the tell. It's not just USD down. It's gold bid. Two different beasts. One is translation, the other is demand. And right now, the market is threatening to be the second beast. But metals traders go even deeper than that. They don't just watch the DXY line, they watch what the FX move forces people to do. Because that's when markets stop being opinion polls and start being machines. Think about how much of the world is short dollars, structurally, whether they admit it or not. Corporates with dollar debt, sovereigns rolling dollar liabilities, banks funding in dollars, emerging markets paying for commodities in dollars, even developed markets running currency hedges. When the dollar weakens in a controlled way, it can be a relief rally across risk assets. When the dollar weakens in a chaotic way, it's a credibility event. It says, your default safe haven is wobbling. And when the default safe haven wobbles, metals stop being a side bet and start being a balance sheet tool. That's why this isn't just gold is up. It's the pricing kernel is changing. And if that sounds abstract, good. Because abstractions are where everyone gets lazy. So let's make it concrete. You just watched a week where policy noise, tariff threats, and geopolitical uncertainty lit a fuse under safe haven demand, while the dollar took a hit at the same time. Normally, in a classic panic, the dollar strengthens because everyone scrambles for dollar liquidity. This time, you're getting something different. Dollar softness alongside a rush into metals. That's not typical. And that difference is the hidden mechanism trying to wave at you. Because if the dollar can't catch a bid during stress, that's not sentiment, that's trust. And trust is where price goes parabolic. Now here's the hidden detail I promised. Simple, but most people ignore it because it doesn't fit inside a 1-minute segment. The price is not the truth. The spread is the truth. When metals traders say, watch FX first, the second half of that sentence is, and then watch the structure, futures curves, spreads, the way near-month contracts behave versus deferred months, whether there's backwardation, tight nearby supply, or contango, easy carry, whether liquidity is thinning, whether the market is paying you to own something now rather than later. That's not emotion, that's logistics. And metals, more than almost any other market, can separate into two realities, paper reality and physical reality. Paper trades fast, physical moves slow with bottlenecks, refining capacity, assay constraints, transport, vaulting, delivery windows. That's why the curve and the spreads matter. Because the curve is where physical tension shows up first, long before your favorite influencer starts screaming short squeeze. So here, this is the setup. DXY is under pressure into a calendar window where markets love to misbehave. Month end, positioning resets, funds rebalance, dealers roll hedges. Liquidity gets patchy because not everyone wants to show size into a weekend when geopolitics can gap you. And when liquidity thins, small flows push big prices. That's not drama, that's microstructure. And the next detail is what flips the whole setup. When the dollar is soft and volatility rises, options positioning becomes gasoline because dealers don't just watch price, they hedge it. They buy when price rises if they're short gamma, they sell when price falls. That's how you get the ugly fast moves that feel like manipulation, but are often just mechanical hedging. And metals are especially prone to this because they attract both macro hedgers and speculative leverage. The moment key levels break, hedging flows can turn a normal trend day into an air pocket or a vertical candle. So let AS translate that into plain English. If gold and silver are breaking out while DXY can AT bounce, there's a real chance you're watching a reflexive loop. Dollar down nudges metals up. Metals up attracts inflows and triggers options hedging. Hedging pushes metals up more. Higher metals prices reinforce the idea that something is wrong, which nudges more capital into hard assets. Meanwhile, the dollar softness reduces the cost of entry for non-USD buyers, and now the loop is feeding itself. That's how you get the kind of week where silver doesn't just grind, it jumps. But here is the trap. The same machine that lifts price can also whip it down violently, even if the bigger thesis is correct. That's where people get emotionally harvested. Before we talk what to watch next, we need to anchor the main drivers that can keep DXY under pressure, because this is where metals traders separate from tourists. Tourists say rates down, dollar down. Traders ask, which rates, real rates or nominal? Which curve point? And what's the rest of the world doing at the same time? Well, because the dollar is relative, it's not a monolith. If the US is cutting while others are stabilizing or even tightening, that's dollar negative. If US growth is slowing while inflation remains sticky, that's messy. Yields can rise while the dollar falls if credibility takes a hit. And credibility is exactly what the market has been testing amid political noise and policy volatility. Now, layer in something that spooked FX traders recently. When authorities even hint they or come where we're watching a currency move, especially USD JPY, the market gets jumpy. A rate check or intervention signal can trigger the largest one-day moves in the yen you all see in months. And because the yen is a big piece of DXY, that matters. More importantly, it changes the psychology. If the market believes the dollar S strength is no longer politically convenient, every rally in DXY becomes sellable. That's not conspiracy, that's incentives. Governments care about funding costs, trade balances, and financial conditions. And when incentives shift, the FX market sniffs it out first. But that's not the part that matters. The part that matters is what a weaker DXY does to the metals complex through 5 separate channels. This is your proof stack. So you are not relying on one fragile story. First channel, the translation channel. Dollar down makes dollar-priced metals cheaper for non-U, S buyers. That is immediate, that is mechanical. It can create real spot demand, not because people suddenly love gold, but because the math changes for buyers in euros, yen, and francs. And when the math changes, procurement desks move. Second channel, the real yield channel. Metals are sensitive to the opportunity cost of holding non-yielding assets. If real yields fall, either because nominal yields drop or inflation expectations rise, gold and silver typically benefit. But here's the twist. If nominal yields rise because investors demand a higher risk premium, while the dollar still falls because confidence is wobbling, metals can rally anyway. That's the credibility event regime, and it's exactly why you cannot reduce this to one headline. Third channel, the hedging channel. Institutions don't buy gold because they're excited. They buy it because it hedges tail risks they can't hedge cleanly with paper promises. When policy becomes unpredictable, the value of an asset without someone else's liability attached goes up. That includes gold. And for silver, you get that plus industrial demand narratives that can turn into procurement urgency when supply constraints are even whispered. Fourth channel, the market structure channel. This is where the curve and spreads tell you whether the move is healthy or stressed. If the front end is bid aggressively relative to the back, it suggests urgency. If you see tighter spreads, higher implied financing, or signs that immediate delivery is being paid up, that's physical tension bleeding into the paper market. You don't need exact inventory numbers to watch the direction. Watch the behavior. Watch what the nearby contracts refuse to do when the market should be calming down. Because if the front end stays tight, that's your tell. Fifth channel, the positioning channel. When the market is leaning one way, short dollars, short metals, long carry trades, sharp moves force de-risking. margin calls don't care about your thesis. They care about your account. A DXY slide can trigger FX vol, which triggers broader risk deleveraging, which can force buying in metals if metals are the hedge people need to rebuild after getting punched elsewhere. And forced buying is the kind of buying that doesn't negotiate on price. Now, what makes this specific moment dangerous, in a good way for trend watchers, and in a bad way for emotional decision making, is the calendar. We're in a window where weekend gaps and thin liquidity can do real damage. You get geopolitical surprises, you get policy tweets, you get sudden clarifications that are really reversals. Markets gap, then the options machine wakes up, and people who thought they had time to react realize they're already late. That's why I keep saying, this is not a slow thesis. It's a fast market wearing a slow mask. And the next detail is what flips the whole setup. If DXY can reclaim a simple zone, call it the 99 to 100 area, then every bounce starts to look like a bull trap. That's the behavioral level. The technical level, do we have the horsepower to reverse at a worse level? Meanwhile, on the downside, if DXY slices cleanly through the mid-97s and can't recover quickly, the market starts to smell a run toward the mid-96 and potentially lower. You don't need to worship those numbers. You just need to respect what they force participants to do. Because if that one level breaks, the math changes. In metals, the equivalent isn't just gold is near $5,000 or silver is over 100. Those are psychological magnets, yes, but the real levels are the ones where the market either retests and holds, showing real demand, or snaps back violently, showing it was mostly leverage. And you need a two-scenario lens here because credibility matters more than hype. Scenario one is the controlled pullback and retest. Price cools off. Everyone declares top. The market bleeds out weak hands, maybe drifts sideways, maybe dips into support. Volatility compresses a bit. DXY tries to bounce. And then, if the thesis is real, metals refuse to break down. They hold higher lows, and the curve stays tighter than it should. Physical chatter doesn't disappear, and when DXY's bounce runs out of steam, metals reignite. This is the healthier scenario. It's the one that builds durable trend. Scenario 2 is the continuation squeeze and gap risk scenario. DXY stays heavy into a weekend or a thin session. A catalyst hits, policy surprise, geopolitical escalation, a sudden intervention signal, a tariff deadline getting real, liquidity vanishes, metals gap higher, options dealers chase, not because they want to, but because they have to. Shorts cover, not because they're convinced, but because their risk manager is calling. That's how you get air pockets up. The reward can be huge, but the emotional damage can be worse because the whipsaws will be savage. And yes, price can whip around violently even if the bigger move is correct. That's the warning label nobody reads until it's too late. So what do you watch in the next week or two so you're not just vibing? First, you watch DXY's bounce attempts, not the intraday wiggles. The closes. Does the dollar bounce and fail? Does it bounce and hold? If it can't reclaim that 99-100 zone with any conviction, the pressure remains. And if it loses the mid-97s and stays there, you're probably not done with metal strength. Second, you watch the metals move relative to the dollar. If DXY is flat and metals still climb, that's a stronger signal than if metals are only rising because the dollar is falling. This is a subtle but powerful filter. It tells you whether demand is broad-based or just translation. Third, you watch volatility and the options vibe. You don't need to stare at every chain. You just need to notice whether breakouts feel sticky. Do dips get bought quickly? Do rallies extend beyond what feels rational? That often means hedging flows are in play. And if hedging flows are in play, you respect gap risk. Fourth, you watch the curve and the spreads. Again, not because you want to cosplay as a futures trader, but because spreads are where stress shows up first. If the front end remains bid, if backwardation appears or deepens, if near-month contracts refuse to relax, the market is telling you something about immediacy. Immediacy is physical. Physical is stubborn. That's why it matters. Fifth, you watch street symptoms, premiums, retail availability, the way dealers talk, the way large buyers time purchases. You don't need a spreadsheet of exact numbers to read the tone. When availability tightens, people stop negotiating and start securing. That shift is everything. But that's not the part that matters. The part that matters is your psychology, because the market will try to use volatility to separate you from your plan. This is the viewer psychology shield, and if you ignore it, you'll donate liquidity to people who don't even know your name. Here's how volatility manipulates you. It makes you personalize randomness. It makes you interpret every dip as betrayal and every pop as confirmation. It triggers urgency when you should be patient, and it triggers fear when you should be systematic. Metals are especially brutal because they can move like a macro asset and then whip like a meme coin when liquidity thins. The goal isn't to predict every tick. The goal is to separate trend signal from noise. Trend signal looks like DXY can't bounce, metals hold higher levels on pullbacks, spreads stay tight, and rallies are followed by shallow consolidations rather than deep collapses. Noise looks like huge spikes followed by instant givebacks, levels that don't hold for a full day, and moves that only happen when one side of the market is forced to puke into thin liquidity. So how do you avoid getting played? You pick your time horizon before the candle prints, not after. You decide what would invalidate your thesis. You treat size like a dial, not a badge of honor. And you remember, the market can be right and still hurt you. A correct thesis with the wrong leverage is still a losing trade. Now, let's talk invalidation without pretending we have perfect foresight. If DXY rips back above 100 and holds, especially if that move comes with calmer policy tone and a stabilization in global risk, then metals may still be strong, but the easy fuel is gone. That's where you should expect deeper pullbacks and more two-way pain. If, on the other hand, DXY stays pinned, fails on every bounce, and especially if the yen and euro keep firming, then the path of least resistance in metals remains higher, with the caveat that the higher you go, the more the market will weaponize volatility to shake you out. And yes, there are real counterpoints. You need them, because a thesis without counterpoints is propaganda. The counterpoint is that a sudden inflation scare, a surprise hawkish pivot, or a genuine global risk-off event can revive the dollar bid fast. Another counterpoint is that metals at big psychological levels attract profit-taking and political commentary. Another counterpoint is that silver in particular is notorious for ripping faces off and then retracing aggressively because it's thinner and more levered. If you can't emotionally survive a 10% swing, you don't get to play the $100 club without consequences. That's not judgment, that's market reality. So here's the cleanest takeaway. DXY under pressure is not the whole story, but it's the first domino metals traders respect. Because it's upstream of demand, it's upstream of hedging, it's upstream of global allocation decisions. And when the first domino wobbles into a thin liquidity calendar window, the second and third domino don't fall politely. If you want a simple checklist for next week, keep it this basic. Watch whether DXY can reclaim 99, 100. Watch whether metals hold their breakout zones on pullbacks. Watch whether spreads stay tight. Watch whether weekend headlines create gap risk. And watch how you feel when the market does something that shouldn't happen. Because that emotional spike is often the moment the market is trying to harvest you. And one more thing, this is the quiet part that separates serious watchers from tourists. If you re-waiting for permission from mainstream commentary, you'll always be late. The signal is rarely where the crowd is staring. The crowd stares at the gold price. Pros stare at the dollar's behavior, the curve, and the forced flows. They stare at incentives. They stare at what has to happen next if a level doesn't recover. That's how you stay ahead without pretending you can predict the exact candle. So if you rue here because you don't want slogans, you want mechanism, you're already in the right room. Stick around this corner of the market where we don't worship narratives, we track pressure, because pressure is truth. And if DXY stays under pressure, metals traders will keep watching the FX signal first, right before everyone else finally admits what the market has been saying all along.